clicked on this video, which means one thing is crystal clear. You are intelligent. Fools don't focus on things that actually matter. They waste their lives on garbage content that keeps them distracted and broke. I need you to listen to this entire video without skipping a single second, because I am about to reveal a secret that most people will never understand, a secret that will fundamentally change your financial future. Do not skip this and end up like the masses of idiots who only dream about wealth but never take action. I am David, and today I am going to show you how a simple $500 start can build you $1 million empire. Most people spend their entire careers working for money, 40 hours a week, 50 weeks a year, decade after decade. They work for it, they sweat for it, and they beg for it. But almost nobody stops to ask the most important question: when does my money start working for me? Mark asked that question. Mark is 26 years old, works a standard office job with a modest salary, and he just received a $500 tax refund. To most people, $500 is a new TV, a weekend trip, or a pair of designer shoes that lose value the second you put them on. To Mark, $500 is the first brick in a fortress. In this video, we are going to walk through exactly how Mark takes that $500 and turns it into a $1.20 million portfolio that pays him over $4,000 every single month in passive income. But before we get to the millions, we have to talk about the trap Mark is escaping. And it's the same trap that is currently rotting your bank account from the inside out. Mark used to think his money was safe in a savings account because the balance didn't go down. But safe and neutral are two very different things. In the last few years, inflation has reached record highs in the United States. If your bank is paying you 0.5% interest while inflation is running at 3% or 4%, you aren't staying level. You are actively losing your purchasing power every single day. Mark realized that leaving money in a bank account is actually the biggest risk he could take. He didn't want to reach the age of 65, only to realize he worked his entire life for a currency that lost its value. Today, his $500 is going to stop being lazy and start working like a disciplined employee. Doing nothing with your money isn't a neutral move. In an era of high inflation, leaving cash in the bank is a conscious decision to stay poor. Mark looks at his account and, for the first time, he doesn't see safety. He sees his wealth shrinking. He's done waiting. Investing gives your money a fighting chance to grow faster than prices rise. And index fund investing provides the clearest, most aggressive path for a beginner to do exactly that. Most people think $500 isn't enough to start because they focus on the size of the deposit, but the reality is they should be focusing on the size of the runway. In today's digital age, fractional shares allow Mark to invest in the most powerful companies in the world with whatever dollar amount he has. If a high-priced stock trades at $500 per share, he can put in $100 and own a fraction of it. $500 is more than enough to build a real position in the S&P 500. And that is exactly what Mark does. He knows that time is worth more than money. The most powerful force in building wealth isn't how much you deposit on day one. It's how many years you give that money to compound. Mark decides to buy the whole market. He chooses the S&P 500, which is a basket of the 500 largest, most successful, and most profitable companies in the United States. When Mark buys one share of an index fund like VOO, he isn't betting on a single horse. He's becoming an owner of Apple, Microsoft, Amazon, and Tesla all at once. If one company fails, the other 499 carry the load. It is the ultimate set it and forget it strategy. But the real secret isn't just owning the companies, it's the fees. Wall Street loves to charge massive fees to manage your money. But Mark chooses low-cost funds where the fee is practically zero. By keeping his costs low, Mark ensures that the growth of the American economy goes directly into his pocket, not a broker's. He understands that in the world of investing, you get what you don't pay for. He sets up an automatic contribution of $125 per week, treating it like a wealth tax he pays to his future self. Now, Let's look at the mathematics of compounding. If Mark's portfolio grows at an average of 10%, which is the historical annual average of the S&P 500, a miracle occurs. For the first few years, it feels incredibly slow. He sees his $500 grow to $600, then $1,000. It doesn't feel like a fortune, and this is where the bev cuff or the fools quit. They want the prize without the process. But by year 15, the interest he earns every year starts to become larger than the money he is actually depositing. His money is now giving birth to more money, and those babies are having babies of their own. This is the inflection point. By year 25, the growth curve goes vertical. He isn't working for the money anymore. The money has become an avalanche that cannot be stopped. Mark doesn't plan to touch this money. He turns on automatic reinvestment so that every dividend payment he receives is used to buy more shares, which in turn earn more dividends. This cycle feeds itself automatically without Mark having to lift a finger after the initial setup. So, what does that $500 tax refund actually turn into? Let's run the projection and look at the cold, hard numbers. In year 1, Mark starts with his $500 and adds $500 every month. By the end of the year, he has roughly $6,800. It's a small start, but the snowball is forming. By year 10, without ever increasing his contribution, his portfolio climbs to $105,000. He hasn't won the lottery. He's just been more disciplined than you. By year 20, the portfolio sits at $385,000. This is where the wealth starts to feel real. But then the third decade hits, and compounding takes complete control of the wheel. By year 30, Mark's portfolio crosses $1,200,000. During those 30 years, Mark only deposited about $180,000 of his own cash. The other $1 million was free money created by the relentless power of compounding and the growth of the American economy. Based on the 4% rule of retirement, Mark can now withdraw $48,000 a year, roughly $4,000, every single month forever, without ever touching his original $1 million. Mark didn't need a high-paying executive job, he didn't need to win the lottery, and he didn't need to be lucky. He just needed to start with $500 and possess the discipline to let time do its job. He has successfully escaped the rat race, while his friends are still working for their next paycheck and complaining about the economy. Mark's money is generating more wealth than his job ever could. He chose to be a producer of wealth rather than a mindless consumer of junk. If you want to see exactly which funds I recommend to start this journey today, click the video on the screen right now. I am David, and your legacy starts with your first $500. Don't let the system keep you poor, and don't let the fools distract you. Take control of your numbers and start building your empire today.